Hey traders, Stephen Kwitzel here with thetradersplan.com. It is Friday, April the 10th. Happy Friday to everybody. I hope everybody has a nice, wonderful Easter weekend. I am shooting this webinar today. The market's closed today, but I'm going to go ahead and shoot it, give you guys an opportunity to watch it today and over the weekend, just so we can kind of, really take a bird's eye view on the market and everything that's going on. So today we're going to look at the individual indices, market breadth. We're going to look at some bonds, some oil, gold, all of that good stuff, and then we're going to look at some ETFs that are really outperforming the market, kind of where the money is flowing. So let's get started. I want to start with the Nasdaq, and then I'm going to move to an S&P 500 chart. But the Nasdaq, you can see right here. So if we'll start at this, right? The Nasdaq dropped 32% from peak to trough, and it has already came 24% off the bottom, but is still 16% off the high. Okay, so still has a ways to go in the recovery lane. I think Monday, when the market surged above the 20-day moving 20-day exponential moving average, surged above this and kind of surged above this pivot, cleared a couple of technical hurdles. Okay, in addition, it failed to fail, and I always say failure to fail equals strength, because if you noticed last week, the market went up to the 20-day, reversed, got rejected, gap down, was riding under the 5-day moving average as a Friday. I thought it was going lower, and then news came out. The death rate is slowing in New York, and that is all the market needed. And Monday it surged, huge, and then it continues to kind of rally. So right now, so there are a couple things to consider, kind of where we're at in the market. How to kind of analyze this. From studying the Nasdaq over the last 21 years, I continue to say, the 20-day exponential moving average, this green line, is the rally line. So when the market kind of surges above that line, you really want to pay attention. In my opinion, you want to be bullish until proven otherwise. Because a lot of times, you can see even right here, like on Monday, the market surged. Right on Tuesday, the market surged at the open and then reversed. So now everyone's thinking, oh Lord, here we go. Here's going to be a whipsaw. And then it, continues to take that out. So I think it's important, especially in these volatile times, to not put too much overemphasis on a one-day bar, but to kind of pick a point at a chart. And in my opinion, it's really this 20-day moving average, or kind of at the bottom of Monday's surge, at the bottom of this week, and say, okay, the rally should continue. And if it rolls over, it rolls over. But I'm going to be as bullish as I possibly can until I'm proven otherwise, because I don't know if the market is going to V-shape out of here. I don't know if it's going to come up here, hit resistance, and then roll back down. And I'm not going to try to guess. I'm just going to pick a point on the chart. I know we got a market breakout right here. I know we're above the 20-day moving average. Technicals are improving. So I'm just going to be bullish no matter what the market says, okay? And if you get whipsawed out, you get whipsawed out. Like, that is part of trading. Like, there's, nothing that is 100%. So, you have to, there's some things you can say, okay, you can make the bearish case, say, okay, this snapback is just a dead cat bounce. It's going to roll back over. I have the 50-day, the 200-day, the 50-day above. I'm at the 50% retracement level. So, there are some technical hurdles above it, but in an uptrend, usually a strong uptrend, technical hurdles, resistance, it's going to get taken out. So I'm almost expecting it to, even though it could come up here, it could pull back, it could go back up. Again, I'm not saying we're going to come straight out of here. I'm just saying right now the market's rallying, and until the rally is over, I would try not to pay too much attention to what's going on in the news, because they can paint a really, really nasty picture, which, rightfully so, everything that's going on. Even though it is hard to imagine that we're just going to climb right out of here, the market always seems to do what I don't think it's going to do, or what, it always goes on longer than expected. The rally always continues longer to the upside, and the bear market always continues longer than we expected to the downside. So you just kind of have to keep that in mind and just really be open, because you know, we could clear above here and base for a while. There's just a lot of different scenarios, but the reality is, you know, we're expected to peak in the next 2 to 3 weeks, and the market sees that. You know, they've already started to buy. So we'll just kind of have to take it week by week, day by day. But for now, kind of my analysis is, let's just see if this bar holds right here, because I can expect a pullback. Now, this is the weekly chart of the S&P 500 going all the way back to mid-2010. So you can see that, you know, this trend line I think is legit. It's been tested several times, got a shakeout. And I don't know what this thing is, but I mean, honestly, the way I look at it is you know, the bear market in the fourth quarter of 2018, when this line broke and it came right back, you know, failure to fail equals strength, and it did not. You know, it briefly broke the line, even though it was a scary bear market, right? Any bear market is, but it reversed, it came right back, and it hit all-time new highs. And it may have had a major rally in the fourth quarter and through mid-February of this year, okay? But, you know, go back and look at this chart and look at all the corrections, right? You have a nasty market and then a multi-year run. You have a nasty market, a double dip correction, and then a very strong multi-year run. Nasty market. This didn't quite make it, but you know, if history tells me anything, and I don't know how long this is going to take, right? I don't know how long this is going to take to settle, to base, to kind of get back out of here, maybe even above this trend line. But strong markets come out of ugly markets, and you usually have multi-year runs. So, you know, if the market wears you out and it just correction after correction, shakeout after shakeout for 6 months, for 9 months, whatever the case is, and then you decide to throw in the towel and invest in bonds for a very long time, you're going to miss it. So I do believe we will get out of this coronavirus bear market. I believe it was such a shakeout. We could have an above average rally, right? Once, you know, and it could take a while. So just my point is, don't pay attention to, don't get sucked into the long-term fear factor. This is a nice buying opportunity for long-term investors and swing trading for short-term. And look at this right here. That was a weekly reversal in the market, right? You had a reversal in the market at the bottom. So on the weekly chart. So you have a reversal in the market at the bottom right here. You had a reversal in the market at the bottom right here. See that bar right there? That is a reversal, right? That is a weekly reversal pattern. So, you know, we can continue to study history. But in this correction, you had a reversal at the bottom. In this bear market, you had a reversal at the bottom. And then you have another one right here. I do not think we are going to undercut these lows. At this point in time, based on there's just a teeny bit of light at the end of the tunnel, could we come back and come close to retesting it? Sure. But do I think we're going to undercut this bar? No, I do not. Not unless just everything gets really bad again and we have a second wave. Okay, so let's look at some breadths. We're going to look at some short-term breadth. We're going to look at the long-term breadth. So this is the percent of stocks that are above the 20-day exponential moving average in the S&P 500. That's a rally right there. Look, we went from damn near zero to 95% of stocks in the S&P 500 above their 20-day moving average. So I would pay attention, right? So now the market is rallying. And again, don't have such a negative view that you're going to miss the rally. Could Thursday have been the peak? Sure. But, you know, it's the point of trend following, the point of a rally is you never know how far they're going to last. Look at the rally that you know, peaked in February. That went on way longer than everyone suspected. So if we look at technology and we look at financials really got a surge. And I think they could be... there's a lot of opportunities in financials, especially if yields start to bounce a little bit. We'll take a look at that chart here in a minute. But if you look across the board, everything is strong. There is really not even energy is weak. Is not weak, excuse me. Materials, utilities, everything is strong right now. Everything is rallying right now. To me, that's bullish in the short term. Now let's look at the long-term picture. Okay, so this is the percent of stocks in the S&P 500 above the 200-day moving average. So more of a long term, you know, you have it, the death cross. The 50 is under the 200-day, right? So it might take a little bit for that to cross back above for us to say kind of we're safe again. Right now, only 23% of stocks are above the 200-day moving average. That is not a lot at all. So if you are looking, so you know, you got about a quarter of stocks, 1 in 4, that are above their 200-day moving average. So in my opinion, if you are looking for some stocks to trade, why not focus on the stocks, you know, that are at least the top quartile, right? The stocks that are at least showing they're holding up or they're bouncing stronger than the rest of the market, right? You could, if you're looking at a list of stocks, you could avoid 3 out of 4 stocks just by paying attention to if the price is above the 200-day moving average. This isn't a magic you know, tool. It's just a very, very simple technical analysis. So right now we have a long way to go to get back to the old highs. A very, very long ways to go. 16-18%, I think, somewhere in there. But again, if you're focusing on some stocks, why not focus on some stocks that either held their 200-day moving average or are currently above their 200-day moving average, because the market clearly likes those stocks better for whatever reason. Okay, so market breadth in the long term is still weak, and the short term is very, very strong. So we'll see how long this rally lasts. Now, if we look at the S&P 500 versus the rest of the world. Now, this is just a simple, the green line is the SPY. The purple line is the All World International Stocks ETF minus the US. And then you got emerging markets, and then you got T-bills. So in the last 12 months, you can see, and this just goes back 12 months, you know, the S&P 500 is down 1%, which it sure does feel like a lot more. But international stocks are down 13%, T-bills are up 1%, emerging markets are up 17%. So looking at this simple chart, it's clear that the U.S. stocks are clearly the place to be. And, you know, I've been kind of waiting on, from 2003 to 2007, international stocks, emerging markets just went on a major, major outperformance run relative to the S&P 500. And for the most part, you've had a year here and there. I think 2016 international stocks outperformed. But the S&P 500, the U.S. stocks still have been the place to be. I've been waiting on, you know, emerging markets, international stocks to go on a 4-year run where they're outperforming the market, and that just hasn't happened yet. The S&P 500 continues to show relative strength. Now, if we look at this year to date, let's just kind of go year to date. We can see that the S&P 500 is down 13% year to date, and emerging markets and international are down 20 and 21% respectively, and T-bills have broken even, right? So again, you know, year to date, 1 year, U.S. stocks are still a stronger place to be. Now let's look at bonds and yields for a second. You know, this is the TLT, the 20-year Treasury bond ETF. So, you know, bonds and yields, interest rates, have an inverse relationship. So when bonds go up, yields are going to go down, and vice versa. Well, we all know that, you know, in the last year or so, really since the end of 2018, bonds have just absolutely taken off. I should have measured this move. Actually, I can do that real quick just to show you how much a simple bond ETF has gone up. This 20-year TLT is up 54% since the bottom in 2018. It's pretty wild for a conservative bond ETF, and you can look right here. You had a breakout of, this was a breakout of a 2-year downtrend, came back, tested it, went up 27%, created a a bull flag, went up 24%, and is now basing again. Does this need a breather? In my opinion, it does, which would mean interest rates should rise a little bit. But this is pretty interesting. You know, you have where bonds have just underperformed for a couple years, and then all of a sudden they just make a major run. So a lot of people think bonds are safe. Well, bonds can go down just like they can go up, but this is pretty interesting. Now, if we look at the bonds are just absolutely going off. Now they're basing. I think this would likely come down. That's probably the bet I would make just because it looks fatigued. But let's look at interest rates, right? This chart goes all the way back to 1974. But look right here, you know, you have a downtrend in interest rates that, you know, a 35-year chart, and then all of a sudden, or 35-year from this peak, and then all of a sudden you have a breakout. You have an inverse, you know, head and shoulders, bottoming pattern, broke the neckline, broke the downtrend line, and then it failed to break out. Just absolutely got slaughtered more than anyone could have possibly imagined. So, and this, you know, sent the bond market higher and sent financials lower, because I want you to look down here. Yields are positively correlated with financials. Well, if yields have hit a bottom, or at least, you know, bonds start going up, I think there is a lot of upside potential in financials. And I'm not sure, you know, banks I'm sure are going to be hurting a little bit their earnings reports based on everything that has to do with the coronavirus, but this is very oversold, and the bonds are very overbought, and I believe there could be a very strong snapback in financials due to the positive correlation with interest rates. Now, historically, if when interest rates rise, that's good for financials. Historically, it's usually negative for utilities. So even though, you know, there can be periods, if it's above this line, it's positively correlated. If it's below, it's negatively. Most of the time, utilities are negatively correlated with interest rates. So just kind of give you a heads up. There can be months or even a year at a time where these relationships decouple from each other. But I think the main point I want to make here is that there could be some opportunities in financials if yields bottom, which based on the oversold and of the interest rates and the overbought of the bonds, I think that's highly likely. Not much happening in oil, but I do want to address it. So let's look at this chart for a second. You know, you have really oil that the whole year of 2019 was just basing, you know, between 50 and 65 bucks, right? So at I think the first week of the year, that is when Iran bombed the Saudi oil field, and the oil markets jumped overnight, but by the next day they were down. I immediately thought, I was like, man, if the oil markets can't even hold a spike when an oil field gets hit, probably is telling me it's going to go down. The market wants to go down. Did I have any idea that it was going to take this kind of, you know, move? No, I didn't. Obviously, I did not make that kind of call. But sometimes you have to look at it and say, okay, if the market, you know, really kind of went down on news when it should have gone up, maybe that means that, and it's consolidating, that it's eventually going to break. And I thought it would break down, but, you know, oil markets were, you know, touched under $20. West Texas Intermediate oil went under $20, I think at the beginning of last week. That's pretty crazy right now. And even though you can look at over here all the way back to the beginning of 2016, and you could have said, man, you know, that was an awesome buying opportunity, but I mean, was it really? You know, when you look at it, yes, you would have made some money in oil, but look, the energy stocks still, for the most part, during this multi-year move from 26 to 75, so when the oil markets tripled absolutely from the bottom, energy markets, if you look at the same time relative to the S&P 500, underperformed the S&P 500. So, in my opinion, if you're going to go out and buy energy stocks because you think they're a good play, which I would be incredibly careful because I think a lot of them will go under, I would just make sure that energy is outperforming the S&P, because you're not going to make it, even though, yes, the reward is great trying to buy something here, you could be holding it for a while waiting on that bounce. And it's just, there's so much technical damage. And again, if you have a very, very long-term view, yeah, maybe you make some money, but why not focus on something that is outperforming the S&P 500 versus, this thing's been under, energy stocks, the XLE has been underperforming the S&P 500, you know, since 2014. So it's just something to keep in mind. You know, when you see a ton of opportunity, I would just, you know, be careful, because this opportunity right here, it didn't yield any fruit, even though it tripled. It didn't yield any fruit relative to the S&P 500, meaning you did not outperform the market, even if you timed the bottom just perfectly over a 2-year period. So, you know, energy stocks versus oil, yeah, those are starting to outperform oil, but that's more to the downside. You know, oil sold off more than the actual stocks did. So, again, I just kind of wanted to address this to show you that, you know, buying at the bottom, you have a reversal last week, but still, it doesn't mean you're going to make a ton of money. Texas went through that. Let's look at a gold chart, because gold is kind of looking interesting. Where is that? Okay. Get a sip of coffee. Now, gold has been frustrating, I'm not going to lie, because, you know, I did this analysis somewhere around here when I first came across this. Now, this is a chart of GLD, and I'm going to walk you through this. I love this chart. You know, I think from like 2005 when gold really took off to 2011, just this ETF alone, it was up 347%. Now, I show you that there were 50% corrections along the way. So 50 or 40% corrections along the way. So just because something's up 347% over a 6-year period doesn't mean there aren't some nasty corrections along the way. Now, so it peaked in 2011 and then it pulled back. But it pulled back to, if you look right here, kind of in between that 50, this is a very, very long-term chart, that 50 to 61 Fibonacci retracement level, okay? Building a major, major base all the way back to 2011. Lots of resistance levels around 130 on this ETF, and then it broke out, right? Everything's bullish now because now it's climbing the right side and close to hitting the 2011 all-time high. So we had a nasty, nasty shakeout last month, but if you look at it kind of on a bigger chart, longer term chart like this, really just the shakeout came and tested this level right here. Right, oops, excuse me. It tested this level right here. Sorry about that. So in the short term, this shakeout was incredibly, incredibly nasty, right? But if you look at the big picture, it tested the 135 zone, right? It tested, you know, what was resistance 1, 2, 3, 4, 5, 6 times now became support. So again, I would pay attention to this. In my opinion, I'm bullish long-term gold still, even though the shakeout last month really kind of tested that position. Kind of wanted to throw it out, but now, you know, the dust has settled a little bit. I'm looking at everything. I'm like, yeah, this long-term chart still looks good. So again, this is a very long-term chart. Doesn't mean that you know, gold is going to take off to the moon in the next few months. This took this took years to develop. But I mean, if you see what I see, I think this is a very, very bullish long-term picture for gold. And if we look down here, I'm going to look at this chart here for a second. This is the GLD relative ratio chart to the S&P 500. So when this line's going down, it means GLD is underperforming the S&P 500, and vice versa. When it's going up, it's outperforming. So it underperformed the S&P 500 for years, then all of a sudden it kind of started to break out relative to the S&P 500 in the last 6 months. And I could even draw another line straight across. Let me draw this right here because you want a definitive breakout. And you can see right here that it's kind of, I mean, it's really looking like this is kind of rounding second maybe. So it broke out of a downtrend, it broke out of a horizontal. So it's just, again, this is a long-term chart, but I think it would be beneficial to have a little bit of gold in your long-term portfolio, or at least consider it if you see what I see right here. Now, this is a chart of the gold miners GDX ETF. The interesting thing is gold miners have underperformed the actual price of gold. They have by quite a bit. When is that going to take shape? I don't know, because when gold miners made this 50% move from 20 to 30 base for 6 months, broke out. I bought a little up here, sold a little here. Eventually, I don't know, I had to get out of the position. But my point is, and then this nasty shakeout happened. I'm really glad I didn't own any. But now it's coming back, right? So it's easy to just get completely scared when something drops 50%. I mean, this dropped from $32 to $16. And then all of a sudden, it's almost back to, $30. It's at 29 bucks. But the ETF, you have to pay attention. So massive shakeout could scare the bejesus out of anybody. Now, all of a sudden, it was up 10% on Thursday. This was the top ETF in the market, or the top industry ETF. Surged above the 200, above the 50, above the 20, clearing a lot of technical hurdles, okay? So, let's just kind of look at a couple of gold stocks. I'm sure you can kind of look at a couple of gold stocks too. But you can see right here, wheat and precious metals, it broke out of a cup with handle. A very, very lopsided cup with handle, but, it broke out of a cup with handle in above average volume on Thursday, right? So that chart looks pretty good. If we look at, Franco-Nevada, and I'm just kind of picking some gold stocks, the chart looks very similar, right? It was up big and above average volume, and maybe the micro gold stocks, the micro caps were up even more. But you have some gold stocks that are already above the 50, already above some major technical hurdles relative to the overall market that are showing some relative strength. So if we go to, so I pay attention to that. So if I go to my industry ETF and, every day I look, okay, what's up the most, what's down the most? So what was up the most on Thursday? Gold, right? We already covered that. Banks, financials. We talked about that a little bit. And I mean, if you look at this regional bank ETF, it was, dropped from 60 to below 27. Or to below 30, like 27 low, like that's over a 50% drop when the market only dropped, 30 to 33% in that range. So I think there is more upside for stronger snapback, even though it just now popped above the 20-day moving average. But look at kind of the volume stepping in. So if the yields have bottomed, the interest rates have bottomed, and they start to tick up a little bit, banks recover from the nasty sell-off, there could be some nice long-term opportunity in the financials, okay? And if we look at that REIT, so you can see financials was up, right, a lot right here. This Vanguard Financials ETF was up a lot. So you have some pockets of strength there. Now, what was down the most? Okay, surprisingly, you have semiconductors did not have a good day on Thursday, even though, relatively speaking, the semiconductors have done, probably in line with the market in this rally. You can see on Monday it cleared the hurdle just like the Nasdaq did, right? But tech stocks actually underperformed a little bit the last few days. The Nasdaq underperformed the S&P 500, and the reason that is because the S&P 500, is more diversified. It has financials, it has the energy sector. It has a lot of different sectors, whereas the Nasdaq is more tech heavy. So and you can see right here that some of the tech ETFs actually underperformed a little bit. And you got some gold miners that did relatively well, okay, and some banks and financials. So I would just pay attention to financials a little bit. Now let's go over to my larger list of ETFs and let's just see what we can find right here. So we'll look at what was up the most in the last month. And out of 239 ETFs, you can see the natural gas ETF was up the most in the last month. So it looks like Saudi Arabia, Russia, so you kind of see a theme here, like a lot of energy stocks. And that's, in my opinion, junk buying. Like, this chart looks like absolute crap. There's nothing good I like about this chart. It's been going down as long. I can go back to, it's really been going down since 2008. Hasn't recovered. It was at $152 and now it's at $5. So, and then you can kind of see some of these oil producing ETFs. And even though, yes, they're popping, still been in a downtrend for years. It's just not a chart I really want to get involved in. I'm kind of just combing through here just to show you. So we know gold was up quite a bit, right? We already looked at that chart, but let's see what else is kind of standing out. Maybe what industry ETFs. Medical devices. Now this is a weekly chart. IHI is the ticker right up here, but you can see the relative strength line has been rising. Definitely some volume that came in medical devices last week. I think that the biotech, the medical device sector, I think this could be, an area of strength over the next 6 to 12 months, just given everything that's going on, the demand that's going to be happening. I think Wall Street definitely wants to put some money in there. If I go down here, you can still see tech stocks in the last month still have done well. You can see that, Hack, you can see technology, software, QQQ. So they have all done well. Let's look at what was up the most this week. So again, oil stocks, dominate the top. I'm not really going to pay attention to that just because they look like crap to me. So if I go down, I'll say, okay, what are some things that are standing out that aren't tech stock, that aren't oil related? Then I come across pharmaceuticals, right? Again, I'm coming across more stuff in the medical industry, the healthcare sector, and then I break it down into industries. So just kind of something to think about. Again, you can probably make money long term in this, but look at USO. This ETF, it surged way off the bottom. It got rejected at the 20-day moving average twice. If you have to play this, I definitely probably would at least wait till it's above its 200-day above its 20-day moving average. Like let it take out the high of Thursday. Let it rally a little bit. And once it rallies, it's probably going to roll back over. So I would definitely have a profit-taking strategy. So I hope this was helpful. I hope everyone has a nice Easter weekend. Let me know if you have any questions.